So we call this outside perspectives because no one up here is an actual commercial banker. And we're supposed to talk about what we see in the world of commercial banking from the perspective of a non-commercial banker. And we're going to touch on some topics that we traditionally touch on with respect to this, like economics, performance of the banking industry. We're also going to talk a lot about technology and the impact of technology on banking. Non-traditionally for this, because we also see technology rolling into competitive pressures, we're going to talk about competition, and then two side effects of competition. Given our august panelists, we're going to talk about the effect of competition on potentially driving consolidation within the industry and investor response to bank performance, and investors' role in potentially leading to changes in market tone and consolidation. Gene, on my left, is going to focus on the regulatory aspects of all of these elements, particularly technology. But to start out, we're going to set the table with Susan Roth Katzke, who is a leading bank analyst at Credit Suisse, and she's going to talk about where the industry is, and then we'll go from there.
Thank you, Rich, and good morning, everyone. So I'm going to talk a little bit about the state of the banking industry from the analyst perspective. And simply put, I'd start with the statement that the banking industry is in a great place fundamentally. If you look at the balance sheets of the banks, which I'm sure you all do, whether it's capital levels, liquidity levels, they're all well in excess of required minimums. If we look at the loan portfolios and loans as a percentage of earning assets for the bigger banks, there's so much more liquidity on the balance sheet, there's so much diversification within the loan portfolios, and there's so much less concentration of risk, especially amongst the bigger banks, that fundamentally we're in a very good place in the banking industry today, some of which is a byproduct of the regulatory framework and its evolution, the CCAR process, etc. So, in very good shape, if you look at the earning power of the banking industry, I want to start with the concept of volatility, where revenue and earnings volatility has been materially reduced through risk management in part. If you look at revenue volatility in particular, it's half what it was today versus the pre-crisis period. So lots of change in business mix. And that change in business mix, despite doing away with a lot of subprime lending, being less active in direct leverage lending, and divesting numerous businesses out of the industry, what you've seen is earning power steadily increasing. If I think about 2018 and where earning power is today, the banks I cover will generate earnings per share growth in excess of 30% this year with a 15% plus return on tangible common equity. So recovering material profitability over the last 3 to 4 years. So in many respects, I think about the fundamentals today as really the best of times for the industry. But on the flip side, being an equity analyst and looking at the stock prices, it's also a little bit of the worst of times. When you look at the bank stocks year to date, as of Friday night, my group was down 10% on average year to date, underperforming the broader market by fully 800 basis points. So it begs the question, what's the issue? Is it the quality of earnings? I would say if you look at healthy 5% revenue growth on average without much loan growth, more operating leverage than we had anticipated at the beginning of the year, lower credit costs than we had anticipated at the beginning of the year, so you've got 15% pre-tax earnings growth. So it's not just about tax reform and share repurchase, it's quality earnings growth being driven by the banks. So it's not the quality of the earnings, it's really a question of sustainability. But to be honest, I don't think anyone would expect 15% pre-tax earnings growth or 30% EPS growth to continue in a 3 to 4% GDP growth environment. But sustainability is the issue, and it's the recurring question of, is this as good as it gets, and how late in the late cycle are we today? And then, how much deceleration in the pace of earnings growth on a go-forward basis? And that's where there are two factors that are going to overhang, in our view, overhang the industry for the next few years in an extending cycle, and that is competition and credit costs. Competition is as intense as it's ever been and only intensifying. The industry remains, as you all know, very highly fragmented. And the nature of competition has changed materially, with bigger banks being far more competitive than they've been in the 30 years that I've covered this industry. Lower unit operating costs, broader franchises, healthy balance sheets, and a determination to invest to take market share. The competition, it's not just coming from the banks, it's also coming from the non-banks. There's not a lot of loan growth, there's not a lot of deposit growth, so you're out there fighting for a smaller slice of a pie. And pricing's already pretty tight on the loan side and increasing on the deposit side. The second factor driving the slower earnings growth is of course credit costs, where I think it's hard to argue that we're not at the cyclical low point today, even though I would have told you this time last year that we were also at a cyclical low point for credit costs. So the issue is sustainability. And the challenges going forward. The challenges become even more acute for those who don't have the breadth of business, who don't have a nationwide footprint, who don't have a brand, who don't have low unit operating costs, or the ability and capability to actively invest in technology and in marketing to be a net market share taker. For those, it's going to be more challenging on a go-forward basis in a stable but moderate growth economy than ever before. So it is late cycle. The question is, how long are we going to be late cycle? Investors are going to sit on the sidelines to some degree until they know how long it's going to be late cycle, because there's always that forward look as opposed to paying for the 30% earnings growth today. No one's paying for that. They're paying for what are you going to give me tomorrow. The stocks are trading now at about 10 times earnings. They've historically traded at 11 to 12 times earnings, suggesting that if I'm looking for 7% earnings growth next year, the average investor is saying, yeah, it's probably going to be more like 5 or 6%, with earnings growth really just coming from share repurchase, and much more concern about the sustainability of revenue growth and the achievability of operating leverage sufficient to cover even moderately rising credit costs. So, it's hard to say which way we go from here. The reality is it's late cycle. In many respects, I would welcome, and I know it's kind of heresy, but I would welcome a turn in the cycle, because I think when the cycle does turn, the industry is going to prove itself to be in a far better position to manage its way through a cycle than ever before, with a cycle more like 1990-91, 2000-2001, so a normal recession. And the strength of these balance sheets will allow you to maneuver through, I believe, with very little in the way of losses for the industry overall, resulting in higher valuations on the other side. To the degree that this cycle extends for several years, I think what we're about to see is repolarization in profitability and results and growth, where we will really see the rise of the fittest in the industry, and then see those who are a little bit less fit to compete, less able to compete, driving in turn more consolidation. So let me stop there.
Okay, that was really great. Let me ask, before going to any particular questions, we have a lot of expertise on this panel who might have some riffs off that or responses to it. Tom, you've got a smile on your face.
I would, because I couldn't agree more. And the one thing I would add is the industry's at a 70-year high in capital. And if you look at the industry a decade after the crisis, which I think is a good starting point to define modern times, the industry is in great shape. And not only in American history, but if you look around the world right now, if you look at how the American bank stocks trade and what their performance is, I think they're shining globally as well. That would be, and then I think we're going to talk about consolidation later, and I couldn't think of a better preamble than what Susan just talked about. So we'll get there at the right time.
I agree. The banks have done a marvelous job of repairing themselves from the crisis, and they're strong, and not just strong by history, but strong globally. So where's the risk? What should we be watching out for?
It's an interesting question, and on a day-to-day basis, whether it's investors who are incredibly concerned with leverage lending and who's got the leverage loans, if it's not the banking industry, and if it's not the banking industry directly participating in leverage lending, then are they indirectly participating in financing others who are doing the leverage lending? And that's the current, I would say, one of the most topical concerns today. Because it's always, look, credit is the biggest swing factor to earnings, right? So it's who's got the most credit risk. Going back to my comments about the strength of the balance sheet, there'll always be losses when the cycle turns. There'll be losses when the cycle doesn't turn. That's the nature of taking risk in the banking industry. I think there's so much less today and so much more manageable. I'm less worried about how the banks deal with growing risks in the leveraged lending space than I am with the non-banks and what happens in that sector as those who have been a little bit more aggressive feel the pain of that aggressiveness without the regulatory oversight.
We talked about the different competition groups. So there's big banks competing against each other, but also big banks competing against small banks and showing success when you look at it, for example, from just deposit growth. But also the tech sector and the non-bank sector competing against big banks and small banks. And those seem to be real drivers of both behavior, but they have good effects and bad effects, right? Because the banks being driven to compete as hard as they have obviously have done a lot of the work that they've done. Give maybe a little more on your perspective of sort of the nature of the competition, right? So when tech firms and non-bank firms are competing they competing based on just a delivery product, a better way to deliver the same product, or are they delivering a new product?
Well, I guess I would say it's some of all of them, right? We've got new providers of aggregation services. We have new direct lending providers. Many of the competitors in the non-bank space, though, are it's not just service, it's really price-based competition. And that's where I think those who succeed in the banking industry will continue to succeed and take market share, because it will always be, there'll be a segment that wants price, and you see that with the hotter money in the deposit growth segment, but there's always a segment that wants service. They want the physical presence of a bank. And they're interesting statistics that some of the big banks will often throw out in terms of how many customers actually still walk through a branch once a month, once a year, once a quarter, really validating the existence of the physical infrastructure. But I do want to make mention that from a competitive standpoint, what's changed so much, and it's really quite stunning to me, is the changing nature of competition within the banking industry. Because for the 30 years that I've watched this industry, it was always the smaller banks, the nichier players that were the net takers of market share, and the big banks were always in a phase of consolidation. Every time you turned around, Bank of America was doing another deal. First Union Michaud, another deal. And so there was tremendous distraction from the bigger banks, and they really enabled many of the smaller banks to grow. And so there weren't unique investment strategies or a need to brand. You just picked up from the fallout of all of the consolidation that was occurring in the post-crisis period, with these bigger banks no longer able to make acquisitions and really being forced to focus on organic growth and putting their heads down and learning how to grow organically for the first time and emerging 2 or 3 years ago as net market share takers. When you have the biggest banks, and if you look at JP Morgan and B of A combined, the two of them are taking more than 30% of the deposit growth in any given quarter. When you've got the two biggest banks who account for more than 20% of the market taking a proportionate share of very little growth, it's very painful for everybody else.
How does that percentage look when you look at the asset side? Is it comparable, or is there a distinction?
In terms of loan growth?
Yeah.
They are much more determined to take deposit growth right now, understanding the value of that core retail deposit.
Yeah, Mitch, I think a couple of things that I would take on that discussion. First of all, I would agree with you that the fact that the big banks only have organic as a means to grow is a significant driver of how they're competing. The second part that comes out of that, frankly, is technology and delivery of service, right? Because the key issue around technology for banks is really changing how you deliver the service to your clients. It's not really a change in the underlying product. I'd say that's different from insurance and other industries where, frankly, the product itself, the need for that product is changing fundamentally because technology is impacting the end user. But if you come back to what are the key determinants there, it means brand. Do you have a national brand? How does that extend? What can you do? The second piece of brand is technology. How do you use technology? How do you extend that effectively, doing it cost effectively across across the country. And then I'd say the third piece, which is really the engagement component of it, is how do you get your customers, I think people focus mainly on the retail side, but equally so on the commercial side. How do you create engagement? And the statistic that is astounding to us is that last year, more than 50% of all the new DBA accounts were opened by the big three, including Wells, in the United States. So that just gives you a sense of the share shift that is occurring away from banks that have less brand recognition, maybe less technology investment, and less capabilities in terms of ensuring engagement by their customers.
This touches on an important element of scale, right? As soon as you mentioned scale as part of it, and the reduction of cost of customer acquisition, and then maintenance of accounts. Scale maybe perhaps could be argued has another element to it, which it permits institutions with a certain amount of scale to try new methods, different techniques to acquire customers, different products and the like, and potentially fail, right? If you fail, if you're very big, it doesn't matter. But when you're a small bank or a small provider, you can't be quite as experimental. I don't know whether there's any validity in that thought.
Oh, I think there's absolutely validity. Think about it. If JP Morgan, Wells Fargo, Bank of America, they're spending $10 billion plus every year on technology, right? They've got, there is at least 30% of that is investment-oriented technology or strategic-oriented technology. That bucket is so big that the ability to take more shots on goal, to your point, and weather a loss because you made an investment in something and it didn't work, okay. You have a bigger pool of funds with which to take the risks and spending versus the bank who may be spending 10% of revenues on technology and may be very targeted in its use of their investment dollars, but is really forced to be very targeted and very careful about how they spend that money because it's fairly limited, and the costs of using technology for things like cyber risk is still increasing, crowding out the ability to be strategic and take a flyer here or there on something that's emerging and new.
The other thing I think, Susan, you focused our attention on, which I think is really important, is the growth and power of the non-banking, non-regulated sector. It just cannot be over time that we're safe in the financial sense as a nation to have one set of institutions that are heavily regulated and some would fairly say over-regulated, and move to another sector that's doing the same thing in many cases, and they're completely unregulated. That anomaly has got to create outsized risk. And what's happened historically is the banking industry has been blamed for the faults of the non-banking sector. Now at a time of peace, relatively speaking, it's really time, it seems to me, to come to grips with this anomaly because it just makes no sense. And the banking industry, unfortunately, will be swept up in it.
Eugene, I think the market may help take care of that. In other words, you talked about competition. I think you have to separate places where the banks have played and places where the banks don't want to play. Because a lot of what you see in terms of new competition is in places the banks don't want to play. Subprime, particularly consumer lending, they've abandoned a lot of that, and so let somebody else do that. In the places that they play, I think the companies that have come into that world have been beneficiaries of very low rates. So take the student loan area where a lot of these companies emerged. SoFi started as a student loan refinance company. There was a pool of loans that basically carried 6 to 7% yields. They could refinance those down to 4.5%. That was a good trade. People were doing that all the time. With wholesale funding costs going up, they can't do that anymore. So they're diversifying into personal loans, places where credit is a big issue. And, frankly, in this rising rate environment, this is a big competitive disadvantage for those kind of platforms. So I think the market may take care of some of that. That is what it is. There's still a huge inherent advantage in the banks, in deposit funding. Huge. So, over time, I think the market may moderate some of that risk that you're talking about because those companies will struggle and fail.
I know Dan told me not to look at this until the end. Someone asked a very controversial question. Something a few years ago, Bill Gates once said that the world needs banking, but maybe not banks. Is that applicable today or in the future? And I think, Mike, you may have just answered that question.
Again, there's a tremendous inherent advantage, and I think someone who's taking deposits, given the history of what deposits mean to the individual, safety, soundness, my ability to get the money, immediate liquidity, someone who's taking deposits ought to be regulated, and, closely regulated. So I think the world is going to continue to need banks, and I just don't, I think what you're seeing now is some of the large banks reacting, as you're saying, Gary, the pilot programs that JP Morgan is doing in terms of just straight direct internet, direct consumer banking, and I think it's St. Louis. So the banks are going to have a reason to be for a hell of a long time.
Well, I think it's right, but I must say, as a former regulator, I'm a worrier by nature, right? Sort of a formally paid worrier. When I look out at the growing non-bank technological community, I'm thinking of the names we all know. For example, one entity that now has 2 locations in New York and Washington. Consumers, at the end of the day, want product. That we do. They don't go out saying, boy, it's going to be a fun day today. Let me go out and get a loan. And they want to get, an iPad or some other game or a house or a car or whatever. And financing is a handmaiden to that transaction. To the extent that we fuzz the line between industry and banking, and with the kids with a technological bent that all our young folks have, the ability to get into the financial system, we see it in payments, of course, and into the core banking system, is profound. And I think if we discount that risk and just rely on our laurels, we're going to do ourselves a real disservice, because that kind of risk can affect the industry and profitability and opportunity pretty profoundly and quickly.
Gene, you raise an interesting question, because I'm sure you've seen these, I don't know what you call them, maybe you call them conduit banks. So in other words, there's a entity that provides a conduit for Amazon to offer a banking account. Right? That, I think, is a threat, and should be something that the regulators, once it gets in size, because right now most of these things are relatively small and maybe the regulators aren't paying attention to it. But ultimately, isn't that just circumventing banking regulation? If Amazon can do everything a bank can do, but it's doing it through some conduit, and it's not regulated, it's that little conduit over there that's regulated. What does that mean?
That's it. That's sort of the big bingo.
Yeah.
Years ago, when there was no interstate banking and when banks were more limited in their service offerings, I remember one former law partner of mine saying, look, streams run to the ocean, and the pressures, the hydraulic pressures to basically get there are such, it's going to happen. Here, I think the hydraulic pressures from these large technology entities are really profound and profoundly worrying in that regard. That, they're going to find a way, if they can, to get into this industry and take profitability away. They've done it in lots of other sectors. So this is an area I think we have reason to be quite concerned. And oddly enough, although when I came here geared up to talk about deregulation, because I think this industry needs more of it. On the other hand, in terms of regulation, the non-banks are getting away with kind of murder. It cannot be sensible to have people doing the very same thing who are unregulated and say that somehow they're not benefiting from the safety net. That's nonsense. If there's a big explosion, they benefit from the safety net. So anyway, I'm just worried.
Gene, I think that you hit the nail on the head with profitability, because whoever's that conduit bank that Michael just mentioned, they're going to be a commodity provider. And technology is going to keep driving the revenues for that activity lower and lower. So that is going to hit the profitability of the industry. And I also think that when we talk all about these non-bank providers, I always try to put myself in the customer's shoes. Who do they think is their bank or their provider? There's been a time where if you said to my kids, who's your bank? They think Venmo is their bank. And in addition to mom and dad at times, I imagine. But they believe that Venmo is their bank, and so I encourage the industry to think about that. Who is the end user, especially with this conduits that we're talking about? Who do they think is their provider? Because I think that is the real battleground. It's happening first in consumer, and then I think we'll eventually go into the commercial market.
Tom, I think that's right. I see that with Mike. Because, by the way, they must have gone to the same school as George Yale. But beyond that, it's exactly right. They're looking at their phone, and they're not wedded to the geographically local, situation that we were when we grew up.
I mean, a couple of statistics that I think are kind of interesting that I saw in millennials. So millennials, in terms of financial wealth, 20 years from now, will exceed the baby boomers by a consequential amount, just to give you a sense. So it really counts. Approximately 67% would rather visit their dentist than their bank. And just to give you a sense of how they view it. So if you look in China, Alibaba, which is the Amazon equivalent, has a money market fund of about $160 billion. It's the largest money market fund in the world. And that's a function of them being able to provide financing features in a less regulated, certainly environment, and certainly a less developed market from a banking standpoint. So I think your perspective is 100% correct. The reality is, I think everyone in this room probably interacts more with Amazon for buying things or what have you than they probably do with their own bank app on a daily or weekly basis. And it's so easy that you just keep doing it. And part of what Amazon has done, and others in the tech industry have done, is they've created ease of use, they've created engagement, and they've created loyalty programs that are really resonate with people using them. I think the last thing I would say, and again, on the payment side, that's probably the tip of the spear in terms of where the impact is hit first. Amazon makes a 20 or 30% margin. Google makes a 20% return on ads that get clicked on, etc. So if they give the payment away for free, they're still making 18 or 17% on that particular transaction. And so the concern that I think you have to have is the banking industry or parts of the banking industry unintended casualties of a bigger theme or a bigger focal point that some of those technology companies are focusing on and trying to.
Absolutely, and it will come to no good, at least in the short and medium term. We all seen this play before. But the problem is that I fear, as would happen in 2007, the banking industry will be swept in, and then we'll have more regulation on the banking industry. Until we get the country to recognize that these anomalies really matter, and we're not getting rid of risk, we're just simply shifting risk. I think this industry pays a disproportionately high and unfair price.
Well, to that point, isn't that the natural? If you go to back to Mike's point about conduits and providers of the ultimate sort of the Venmos of the world and the like, maybe that's not a good example. Amazon's a better example. Really providing products that they're not providing because it's provided by somewhere else. The opacity of the market and the absence of the customer's ultimate knowledge of who they're doing business with. I mean, this sort of harkens back to, in my mind as a lawyer, to times when there was so much focus on making sure there was transparency, so people knew what they were getting and from whom. And how does it, as an ex-regulator, right, put your, I guess that's the re-regulation hat on. How do you think the regulators view that problem, and how are they going to come to grips with it?
Well, we have such a fractional regulatory system, which is one thing I wanted to speak about today, because I think we're at the end of a deregulatory cycle, and it's really incumbent upon the industry to take advantage of that, and we have regulators in place. To answer your question, Rich, that they're narrowly focused. Joe's body is focused on the national banking rules. The Fed is focused on a broader set of monetary issues, but really from a regulatory perspective on its constituencies, and same thing with the FDIC. And the FSOC is still finding its way, you might say, a potentially valuable body to ask these questions. But it's really not at the moment, asking these questions in coherent ways. It wasn't kind of set up that way. But as you say it, that would be the body, it seems to me, that ought to begin to address things in a broader way. But what it seems to me that beyond addressing the broader questions, I think we ought to take advantage of this period of time to address the narrower banking questions. Because we're not going to be able to, I think we have to prepare for, I think we have to talk about, I think we have to focus the Fed in particular on this broader issue of the unregulated. But for this industry, I think we have to focus primarily on the deregulatory opportunities that we face. And there, we don't have much time left. It isn't so much that the House has changed in terms of its composition. That doesn't help, right? Chairman Waters, and I believe there will be Chairman Waters, has already indicated that she's no big fan of deregulation, but she knows how to do business. She's a capable person. But I don't think that's the big issue. The big issue is the end of the financial cycle, which I think most of us agree is on the horizon. In fact, most of us agree is it's good news because when everybody agrees with something, it's less likely to happen. But I think most people in the room would believe that we're heading towards the end of the cycle. And what will happen, even if it's not a terrible downturn, regulators will refocus, right? They're going to be up there having oversight hearings on how bad is it? How bad is this credit? They're not going to be focusing on deregulation. So now is the time. It's carpe diem. And as everybody in the room knows, the nature of regulation is there, lots of stuff that doesn't work, and there's lots of old stuff that is mistargeted. And so I have several suggestions I brought with me. One, I think we really ought to try to get the entire mechanism to recognize that there are too many regulators in an institution, and that they ought to choose among them to have a more targeted regulatory exam, because in practice what we live, where regulation is really overburdening, is on the ground day to day. And that there's too little focus on that, even with the current crowd of regulators we have, which are good-hearted and well-meaning. I think there's too little focus on the ground. The second thing, it seems to me, that we ought to be focusing on, and this is not sort of a popular issue, I think it's popular as it ought to be in the financial institutions, and that is a fair right of appeal. Everybody is targeted every day or threatened by some regulatory action. It's almost impossible to run a large institution with having no mistakes. And in some cases, there are real mistakes, and in some cases, regulators, however good-hearted and competent they are, and I think they're highly competent, make mistakes like everybody else. And without an ability to appeal, without retribution, we're always at a tremendous disadvantage. And this is a bipartisan issue. Both sides of the aisle understand that there's something not working here. And with this regulatory bunch, it really is an opportunity, I think, to address that profoundly important issue. Now, it's this kind of nerdy thing, right? It's not one of these things that's like lowering capital. Yay, we don't lower capital. It's a little nerdier and it's harder, but it's a huge opportunity, I think, for progress. And the third thing with this crowd, I think we ought to be doing that, I think is profoundly important, is taking their sensible focus on the need for innovation, because you're not even going to be able to solve the regulatory problems in the 21st century without having new technologies and new approaches. And take that and really try to advance the thinking so that the agencies themselves begin to support efficiencies. And don't view efficiencies as contrary to safety and soundness. All three of these things improve safety and soundness that I've suggested. One, to the extent we have individual regulators taking responsibility, that's really improves safety and soundness, because we all know committees don't do it. The regulators know committees don't do it. So committees of regulators are unlikely to do it. Similarly, it seems to me, to the extent that we challenge regulatory mistakes, we actually improve the regulatory process, and that's safety and soundness. And three, in terms of innovation, both for the regulators and for the industry, one can do things incredibly more efficiently and more effectively that everybody benefits from. So I'll get off my hobby horse. But
all very illuminating. It's a good checklist for everyone to take time. Tom, to pick up on the point we touched on a little earlier, so the things that Susan introduced and that we talked about, appear to be, I think you're going to explain to us, should be drivers for consolidation.
Yep. Well, consolidation is underway. Just to remind everybody, the first interstate banking laws in the United States were passed and became effective in the mid-'80s. So this is generally modern times. We've been able to see the whole consolidation story happen. We have 25% fewer banks today than we had a decade ago. And what's important too is to think about how you measure deal activity. It used to be how many deals in a year or what's the size of the deal value. One way that we're looking at it is by what percentage of the industry is involved in consolidation every year. The average since consolidation began is about 3.6%. Right now we're running at a rate very close to 5%. So it's actually a very fast level of consolidation of the industry that we have today. But it's very different than what it used to be. Susan mentioned it earlier. The big banks really are not involved. It's for a variety of reasons. They're at the deposit cap, they can't acquire other companies, they have regulatory challenges, they needed to adjust to the new environment. So really the consolidation's been happening below that. I think where it's been happening that's most interesting is the development of regional champions. For offensive and defensive reasons, we're seeing banks, let's say in that $10 and $20 billion range, coming together to be able to create a company that can better compete today and going forward. You've also had a regulatory impact. So only 4 banks really tried to pass the $50 billion threshold since Dodd-Frank was passed a decade ago. Meanwhile, the number of 20 to $50 billion banks doubled. So you had really a little bit of a congestion issue with the industry where the industry didn't feel like it was good for their companies to cross 50 billion and become a SIFI. So now that that's been removed with the banking bill last year, earlier in the year, we believe that you're going to see a lot more consolidation in this 10 to $50 billion range, and you're going to have companies standing up to try to become regional champions to afford a lot of the investment that we've all been talking about. So I think that's where you see it. You will see periodically bigger banks involved. We have seen Fifth Third decide that Chicago is very important to it. It acquired MB Financial. I also think you're going to start seeing more cross-financial services consolidation happen. For example, we recently worked with Silicon Valley Bank that bought Lee Ring Capital Partners to develop a universal banking model, for example. The asset management industry right now, those securities are probably at a very wide degree of valuation discount to the banking industry. I think you could see banks start to look at that sector, for example. So excuse me, I do think you'll start to see the big banks take this higher level of profitability and not go by a traditional branch system. Part of the dynamic that was underneath all of our conversation here, which is how important are branches? I mean, you've got 2 of the industry leaders, Wells Fargo, Bank of America, closing or selling rural and suburban branches, but yet opening lots of branches in new cities. So it's becoming much more of an urban franchise where maybe technology will be used to service the suburban and rural areas. So we do expect to see continued relatively high pace of consolidation, but more in the regional bank area as these regional champions start to get stood up. And then just real quickly, there are offensive reasons to do consolidation as well. A deal was announced yesterday where Center State Financial acquired National Bank of Commerce, National Commerce. It was a deal where the acquiring company was able to announce 5% earnings per share accretion and only 2 years, up to 2 years of book value earned back. I think investors would view that as a very offensive move for Center State. The stock did outperform yesterday. But at the same time, for National Commerce, it's great to have a bigger partner who could afford a lot of those digital investments. So those are many of the drivers. There are a lot of other headwinds and tailwinds. Investors have not been terribly receptive to bank consolidation in the last 18 months. We've had some examples. Yesterday was a good one where the immediate reaction was positive and the stock outperformed. But we expect it to be busy, but not the traditional front page, Nations Bank, Bank of America merging. We expect to see it more in the regional bank area.
How do you see the investor response? I mean, you touched on it, right? You haven't seen a lot of deals well received. Investors, I think, still are quite hesitant to see, anything of size.
I've never seen them be more disciplined to what I call the checklist. And so we've created a checklist of what we think is important. Investors want to see, and they want it all. They'd like it to have good strategic rationale. They'd like it to have reasonable assumptions. Yesterday's cost savings was 25%, which the market believes is reasonable. They want to see appropriate, we call them financial guardrails. They don't want to see too much book value dilution because they've been down that path before and know the dangers of that. And they'd like to think that the company is ultimately more valuable afterwards. And they also want to know they've got a management team that can execute. So these are a variety of checklists, and if one of them doesn't look right, investors will penalize the acquiring company. And that's a whole other feature, which is we're seeing market premiums decline for targets. And it's because investors are expecting to get more of the benefit out of the combined company. So there has been a shift from the where the benefit's going. They're starting to shift more of moving away from the seller to being more now shared with the buyers. And that is, we're seeing that in a lot of the deal design of the last couple of years.
So Mitch, a couple of things I would add. We recently had top 25 bank investors at a conference that we hosted with Sullivan and Comwell. A couple of things came out of that I think are kind of interesting. I agree, Tom, with what you said. First of all, consolidation, at least in the US market, is essentially a North American affair. It's US banks, it's Canadian banks. Don't expect much out of Europe, don't expect much out of Japan. They're all focused on the domestic markets and the domestic valuations, which I think, as Susan pointed out, are quite a lot below those of the US banks. Second issue I think that people are focused on is return on capital and return off capital. And that's one of the reasons why tangible book value earn back is such a core driver. And what that implies is banks that trade at a higher tangible book multiple or have a higher return on their capital essentially are guided to win. They are going to get a bigger free pass in terms of making acquisitions because the dilution to their tangible book is lower, which is the strong get stronger and presumably the weak don't survive, is the competitive tension or factor that's driving that. The last thing I would say that I think is important as you think about consolidation, and this is one of the quotes that really resonated with me, is in cases of big premiums, investors' views are guilty until proven innocent. So I do agree with you 100% that premiums are coming down. As a part of that, I do think the one factor that was mentioned, which again I would say is interesting, is against the very large banks. There is a view that well thought out low premium mergers amongst larger banks is something that's acceptable. But to Tom's point, I think it needs to touch on good strategic logic, good financial metrics, shared upside for both shareholders, and obviously a clear structure of how the business is going to be run, what it looks like going forward, and what the competitive dynamic of that institution is going to be relative to the larger bank that's competing against.
Just picking up on something you said, Tom, that the $50 billion barrier effectively having been a regulatorily imposed order to growth. Now that's gone. We've seen growth lower. As these regional champions, to use your term, develop, is there a size profile? Are there economic elements that drive considerations of where the right spot is?
So we've been measuring the sweet spot for profitability in the industry since the crisis. There was a time when it was $2.5 billion to $5 billion. It's been marching upwards almost every 6 months. Right now, the sweet spot we identify as the most profitable banks in America are the $10 to $25 billion banks, but it used to be heavily skewed. It's been flattening out. The bigger banks are catching up, and I would say we're probably in a moment where the bigger banks right now, on average, have become more profitable, and that transition is happening right now.
What do you think drives that?
I think the driver is, first of all, I think it's deposits. The value of deposits, I think, is going to turn out to be ultimately higher than what everyone thought even a year ago, because the non-bank competitors are getting more traction and consumers are more comfortable opening an online banking account than they've ever been. So I think this deposit acquisition is a real strategic and profitability advantage, number one. I think number two is, boy, there was a lot of regulatory change with Dodd-Frank, and I think there was an adjustment period. I think it took a while for these big banks to essentially, for lack of a better financial term, get their mojo back. And I think they've got that back now. And then the capital return story. So for the top 24 banks that we measure, they're going to return a median of 100% of their earnings to investors. So you'll see a model where you'll have maybe 4% revenue growth, very little expense growth, 6% per year share repurchase, and you're going to see a material improvement in profitability. And then one thing we talk about with the industry is, what are the big banks going to do with all that? I think they're going to keep investing and keep getting better. So I think this competitive challenge is changing, and this is why the bigger banks, I think their ability to compete is very strong and getting stronger.
If I chime in here, I think it's the deposits and the value of the deposits, but I think that we've always talked about scale in the banking industry, and it was legitimate for many years to understand that scale actually worked against you, and scale was simply size. I think part of this organic inward focus and the big banks getting their mojo, to use your phrase, that has really been to realize scale economies for the first time in decades. And the ability to not only have value-added rewards packages that keep the deposits in-house, but drive down unit operating costs through automation. And I think what we're hearing from bank managements is that today they're automating processes that they didn't even know they could automate 2 years ago. So the use of technology, the leverage of technology to lower those unit operating costs, the way we look at scale in the banking industry, we have the largest banks as becoming the most profitable banks 2 years out, more so than the 10 to 20 billion. And we think that scale will ultimately, with that line moving from 50 billion to, in our view, with the new tailoring proposal, 700 billion in assets, we believe we will see some very large mergers, and with banks kind of taking that, the upfront cost of having to pause and to integrate to become that first mover to cross the 700 billion and challenge Wells, B of A, JP Morgan for scale, for fear of otherwise being left out.
Susan, what you said about technology is profoundly right. We're only at the very early stages of the technological revolution. You know, folks can say, oh my God, me too. What's happened in our lifetime is amazing. We're kind of a sense of there. It's not there. We're just at the beginnings. And there are pluses and minuses. Cyber risk and cyber issues are a bigger deal. Regulation will tilt towards much more, data reviews and other reviews that we didn't live through before. But having said all of that, the ability for the industry to become vastly more efficient, more profitable, and get into, really interesting other activities and approaches to finance is really right at our doorstep.
I mean, that kind of trade-off when you think about consolidation right now and entering into a deal, the distraction that comes with integration is the biggest cost to any bank that participates today, right? I mean, if you've got banks who can survive and thrive independently, they will benefit from any other bank's merger. But not accepting that distraction to move forward to actually benefit from scale economies will be an equal longer-term cost to those who don't participate.
And I personally think the 50 to $75 billion banks may not be able to afford all the investments that you were talking about, or just won't get the economies of what a $2 trillion balance sheet does for you. So I do agree. I think it'll be two pieces. You'll see the regional champions continue to evolve, and then see some of those begin to join the bigger company.
Yeah, so, I mean, Mike might also have a thought on this particular topic, but does the growth in partnerships with fintech firms to provide products help the more modest-sized banks balance against that inherent scale benefit.
Yeah, I was going to ask you, go back to your acquisition, consolidation, banks buying on banks. Do you, how do you handicap the possibility that, obviously there's been a tremendous amount of innovation in the online banking space, and Gary mentioned, it's all about the user experience, right? Okay, people are more comfortable interacting mobilely or more comfortable interacting digitally. So a lot of business has been built around a very good customer experience. They're still delivering a loan. They still have to know how to underwrite the loan. They still have to know how to finance the loan. But it's a good user experience, and that's where some of the companies have some struggles. But do you see ultimately the bank saying, I'd rather buy that than build it. I marry that with my cost of funds. That's a tremendous advantage. And I think we have to see a material weakening in valuations for those companies because they're all built on excessive valuation today. But it would be comparable to what BlackRock did with Future Advisors, buying a robo-advisor and just saying it's easier for me to buy that rather than build it. It would be comparable to what Navient did with Earnest in the student loan space. Do you foresee something like that?
It's interesting because there's been talk about is, will fintech replace banks? I think it's a collision.
Yeah.
And I think the banking industry has the greatest hand of cards at the table. They've got customers, they've got earnings, and there will be a point where regulation will be a good thing. Right now, regulation and safety and soundness is invisible. We'll get to a crisis where folks will realize that safety and soundness is important. So when you look at all those things, I think the best fintech companies in the world right now are inside some of those big banks. So they will, and they're spending a great amount of money, and they've got all this advantage. So I think it's a collision, but there will be some winners who aren't traditional banks. But I think, like you said earlier, the market's going to figure it out for everybody. The ones who aren't succeeding, it'll be obvious in their share price, and then they'll become an opportunity for the bigger companies.
Tom, I think you're profoundly right in the sense that the banks have a huge opportunity here because being able to take advantage of the fintechs, that innovation and ingest it with core strengths that they don't have, including regulatory muscle. Because at the end of the day, the fintechs are vendors, and they have, at the very least, the vendor management rules to live with. And increasingly, the vendor management rules, and I predict, particularly in the tech space, will look a lot like banking requirements in terms of what technology companies have to adhere to. And it gives the banks an inherent advantage that's pretty profound.
But it has to be earned, Boyd, and you need good leadership right now. Because if you're standing still, you're really falling behind.
Yeah.
So I don't think it's not a birthright. You got to earn it. But I think the banks have a good chance.
And there'll be winners and losers. Some folks are going to get the joke, and other people will lag behind.
Yeah.
Okay. Well, should I turn to questions? Okay. I've tried to pick up some of the questions in the pigeonhole as we went. I can multitask, I guess, but only a little bit. There is one here, I think Susan particularly is probably for you, maybe Gene. If leverage loans are held primarily outside banks and not short-term funded, is there any financial stability concern if they go bad? Maybe a too broad question, but anyone have a...
Yeah. At the end of the day, one of the things that has not worked in the last 50 years, or at least worked well, is the ability to get away from the risk for banking organizations. Many of the mechanisms that we've seen evolve from derivatives on were attempts to basically lower risk and be more efficient. Theoretically, all these things are good things, but the fact of the matter is it's been very hard to get away from the tar baby, and as everybody in the room knows, that if you make a loan to a sector, it's very hard to trace all the consequences of that loan through other entities. And here, I fear that one way or the other, the risk will come back to the banking system if it doesn't examine it carefully. So, for example, yes, it may not be making the leverage loan, but does it have exposure to the entity that's making the leverage loan, or the entity to whom the leverage loan was made, or other entities affected by any of these parties, and if so, to what degree? And so that kind of analysis is just absolutely critical. So I would say that the fact that there is a risk in the financial system that is potentially profound, it really is likely to come back to the banking system one way or the other, and the only way an institution can protect itself is minutely looking at that in a clear-eyed way.
And Mitch, you mentioned too something about non-banks in this lending. I think what's going to be different this time is how quickly a problem becomes a big problem. Because banks have an inherent ability with deposits to work with problem customers and try to work through and redesign a credit if they feel like they're getting cooperation all around the table. Some of these non-bank lenders have different types of investors, different funding structures, and you may see an effort to get the bankruptcy go faster. So I think we've seen some examples of that already, and I think that'll be something to watch in the next cycle as to how these non-bank players act when you get into a workout situation.
Which is, when you think about the comments about bringing more regulation back into the banking, more of the non-bank regulation into play, there is absolutely the indirect risk that comes with the growth in leverage lending and what we're seeing in terms of late cycle behavior and more leverage in deals. And it's always striking to me when you look at something like the Shared National Credit exam, right? And the majority of the loans that are criticized in that exam are outside of the banking industry. So it's not going to be directly on the bank's balance sheet in a traditional credit risk way. But whether it's the investor who takes the hit and then goes bankrupt and their credit card loan goes bad, it will all come back to the banking industry in part or in whole as the provider of risk and financing.
Yeah, but those are both really profoundly important comments because we all know that the further the credit gets away from the original provider, the riskier the periphery is. And sadly, what's happened in finance, is this association from the originator and the balance sheet, because banks were really good at working out difficult situations, and unfortunately never been lauded adequately for that and keeping the economy going. The more we have this expand, one, it happens very quickly, and number two, at the end of the periphery, there's an inability, sometimes because it's trusted, or an unwillingness to basically deal with the underlying credit problem.
Yeah, following on this, one of the questions that was asked was what kinds of specific regulatory, bank regulatory frameworks would you apply to the fintechs? We talked about that, the need to bring it within regulation. Specifically as capital liquidity, consumer rights, and activity limits. I think some of those probably, they're all controversial, but they might, from a macro safety and soundness perspective, make some sense.
Mitch, I think that the one way to think about this, which is a simple way to do it, but it's obviously more complex in application, but is like kind, like size, like regulation. In other words, so entities that are teeny players into this one thing, entities that are big players, it's another thing. And if the banking industry has to ingest this level of regulation for that kind of risk, then other entities ought to be able to have to ingest it the same way in terms of what you just said, capital, reserves, supervision, examination.
I think we have time for me to take one more of these. And Tom, this is triggered by your point about right sizing. So the question is the opposite. In this world that's more highly competitive, is there a size of bank that's most at risk? Whatever you can define risk however you like.
I think the scale, the fact that we're now in a period in our industry where economy of scale is really starting to work. So that does reward bigger, so you'll get better scale. But I think below $1 billion, and I don't think that's really this group, but I think that could be a risky place to be. And by the way, over 90% of the banks in America are less than $1 billion. So that's really where the number of banks are, not where the assets are. But those banks are more narrow, they're more spread dependent, they're more real estate heavy, If we were to have just a fun debate, as we have, what is it, 5,700 banks today, in a decade, how many do you think we'll have? I think a lot of those smaller institutions are going to find it hard to compete in this area. So I mean, I think that would be the most likely place to go. And I think there'll be successful banks at all asset sizes. There's always the exception. But I think that you're going to see more consolidation and on average bigger banks develop.
Okay, any final thoughts that you want to share?
And I would, well, two things I would add. One is the underlying profitability, Susan, where you began, has been a big factor which has made big banks do well. Look at Europe. There are a lot of big banks there not doing particularly well because the underlying profitability is not there. So you have to have underlying profitability. You have to have strong and good leadership, a clear strategy of what you're doing first and foremost before you get into size from a relative standpoint. And the final thing I would say from at least my perspective is the one piece that we see a significant pickup on in our practice is investors calling managements and boards to account. The incidence of activism in financial services has gone up dramatically. It will continue. Around 15% of the directors in the United States have been replaced over the last 5 or 6 years by activists. So expect a far more and far deeper set of dialogues with investors around what you're doing, why you're doing it, and what the consequences of taking those actions are.
Okay, thank you very much. Thank you for your kind attention.